The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the podcast on Thursday, the 11th of February, 2021. On the podcast today, Siro Cicconi, CEO of Zaim Credit Systems, talks about their current trading. Also on the podcast, Vadim Alexandre, Head of Healthcare at SP Angel, talks about tissue Regenix. Also mentions Novacyt Omega Diagnostics. And John Meyer, mining analyst and partner at SP Angel, talks about the Commodities Super-Cycle and mentions the following companies: Altus Strategies, Bushveld Minerals, and Solgold. And as always, at the end of the podcast, two lists for you: the top 5 most followed companies on Vox Markets in the last 24 hours, and the top 5 most liked or most read RNSs too. By the way, you can see both these lists at voxmarkets.co.uk, where there's articles. In fact, there's a reminder there: register here for MGC Pharmaceuticals webinar tomorrow at 10 a.m. and I'll be the host there. So it's done very well, actually. Share price of that, it's gone by 50% since its IPO. So worth looking at. Of course, they're in the cannabis area, cannabis sector. Plus, there's also lots of other video content there and articles. Northbridge Industrial Services CEO Eric Hook discusses their final or the latest trading update. There's also Sigma Rock launches UK's first cement-free carbon concrete building block. Very interesting. And our COVID-19 index, of course, biggest rise of the day, N4 Pharma, up 30%, 10.6. Biggest faller is Cromet Group, down 6.18 to 19.75 pence. Check that out at voxmarkets.co.uk.
Vox Markets is an online community of investors that runs a free mobile and desktop platform that allows you to track news and updates about any UK-listed company, offering RNS push notifications, detailed charts, pricing data, and much more. Find out more at voxmarkets.co.uk/app.
Joining me today on the podcast is Siro Cicconi, CEO of the Russian-focused fintech group Zaim Credit Systems. Thanks for joining me today, Siro.
Good morning, Francesca. Thank you for inviting me. It's a pleasure to be here.
Thank you. Now, just quickly for investors who might be listening but aren't necessarily familiar with Zaim, can you just tell us a little bit about the company and what it does exactly?
Zaim is a company, is a fintech platform which provides microfinancial services to the lowest segment of population. Let me say we work prevalently with unbanked and unbankable. And we have developed along the years a system, a business model, and a range of services that allow us to give a solid, then consistent service and profitable for us and for investors.
That's great. Now, shares in the company have rallied by over 80% in value since the beginning of November last year. And I understand you recently posted a trading update, which probably both reflects and explains this activity. So that was an update for your fourth quarter, as well as for the full 2020 financial year. Could you just break down for us what the key findings of this report were?
When we went on IPO, we declared that we were aiming to make a transition from the traditional offline business model to an online one. Then the COVID appeared, and we went through a very hard moment, which has improved the reactivity of the team. And we have accelerated the transition, and we have basically closed 60 stores over 90 and migrated the business to the online. And from July on, we are consistently growing and generating profit and positive cash. We have constantly informed the market about these progresses, about all the events we have done. And now we are happy. I am particularly happy to announce that the migration to the online has been successfully executed. The business model has proven to be resilient and extremely performing even on hard moments. And the best is yet to come. So I think the rally is just the consequence of all these actions that have been put in place by us along these months. And I hope, and I'm pretty sure that the market will appreciate what we are going to do in the coming months.
That's great. And sort of touching on the challenges posed, I noticed that you described the past year as a turning point for the company. By this, are you talking specifically about the company's transition from offline to online? And perhaps just to give some context, could you maybe just explain sort of the basic reasons behind the move, apart from the obvious?
Let's say that we used to be a company, used to be maybe among the biggest companies operating on the traditional stores business model. We perceived the power, the potential of the growth online, and we decided to go through an IPO process to raise the capital necessary to fund this transition and to fund the growth of the business. This is basically what was before the IPO. We went through the IPO and we simply did what we promised to do. That's simple, which is, but makes me particularly proud because it's always a pleasure to say simply mission accomplished. Now, just to give you an idea, when you work on offline basis, you have a physical range of the distance of from the store, and that's the basin of potential clients. With our online platform, we can operate on the entire territory of the country, but we can operate any passport bearer of Russian Federation all over the world. This means that we can work. We have no boundaries given by the physical presence, and of course, market is n times bigger, and we are seeing this. I have to say also that there are a lot of minor positive events that have also fueled this growth, because we have improved our scoring system. We have a much more efficient management of the cash generated. I think that, as I told you, the investors community has appreciated that the company is growing and is generating profit and cash, which is quite unique, or let me say very rare, that the three things appear at the same moment.
And you remained cash generative throughout the period that you reported to me, right?
We have always been cash generative, and because we have tuned the growth, we didn't want to be overstretched. We could have grown much more, but we prefer to have a healthy and cash generative growth. And we always very, very cautious when we move forward. And it's time to say we have a good payout.
Great. And just quickly touching on the online business, you've said in your recent news that it's now at a substantial and sustainable level, which comprises about 76% of the overall business. How do you see this in terms of projection and the sort of further benefits of an online focused strategy going forward?
Well, the online is a huge universe, and we are going to exploit it as much as possible, always with a healthy approach, as I told you. I have to say that we have a strategy also for the offline, because we have a network of 30 stores focused on Moscow city and region, and which anyway is a quite important retail network stores. And we are going to implement this year a specific strategy to make them even much more profitable than they are now. But of course, the focus is on the online. As we announced in last quarter, by the end of Q1 this year, we will release the mobile app. And the mobile app will be quite a relevant milestone in the company's growth, let me say, in company's history. Because on the mobile app, we are putting a big effort in terms of project, in terms of ideas, contribution. The mobile app is a tool that will allow us to be close to our clients 24/7. And through the mobile app, we are going to provide to our clients a much broader range of services that we are shaping in this period, that we can provide by using the relevant amount of clean data that we own. Never forget, we have close to 400,000 clients, active clients, a few more hundreds non-active, but we have a very clean data, and we are processing them by using items of artificial intelligence and very sophisticated mechanisms. And so I think that for the future, we will experience further and more, let me say, with higher technological profile growth of the business of the company and the profitability.
That's great. And do you see this mobile app, I don't know if it's sort of too early to say, but as a solution that will fit into your strategy for both, for both online and offline in terms of strategy?
Yes. All. Let me say, our company is a whole. So all components work together and cooperate in the strategy. So the mobile app will be a part of the strategy and will be a support for both segments. Especially because, as I told you, we are starting to see it broadening also of the services that we will provide through the mobile app.
Yeah.
The mobile app for us will be a way to be close to our clients 24/7. Anytime our clients should need us, we will be there. And that's the approach. We have always told that we certainly are a fintech platform, but we also look at the possibility of providing services that ease or simplify the life level of the lowest segment of population. We have a social impacting, let's say, approach to business. And we think that the mobile app will represent important milestone in the growth of our company.
Yes. Okay, I understand. And looking forward, what can you say in terms of long-term outlook for the company, as well as, having the strategy for a mobile app? Is there anything else you can say?
Let's say that we have an approach we have an outlook which is based on our approach. Our approach is that we are always in control of our growth. We decide how to grow in the meaning that we always want to have an healthy growth, cash generative, and to have the company always ready to react to any unforeseen event. That said, we are operating an amazingly growing market, and in a growing market, we are certainly among the best performing companies in terms of performance, also from the client perception point of view. So my outlook is extremely positive. I think we will have a long-term growth path, and we are ready and fit to get it, to enjoy for it.
That's great. Now, just on a final note, if you want to sort of outline 3 reasons why, Zaim Credit Systems should be of interest to any potential investors listening, why listeners should add the company to the Vox Markets watch list. This is a question Justin usually asks. Could you give some context here, just outlining what you think is the most important takeaway from this?
So 3 reasons for me can be, number 1, the quality of the company in terms of consistency of the performance. As I told you, we have delivered what we promised at the IPO. We are delivering on monthly basis results that are often exceeding the expectation. Number 2, the market opportunity. We are operating into a market which is growing 25% year on year, compounded, and given the macroeconomic trends, we all expect the market to keep this growth for many more years. And moreover, our technology can easily be scaled into other countries. But at the moment, we are focused on the country and on the market we know. And the number 3 is the profitability, both for the company and for investors, because we are a company whose growth expectation can exceed even the startups, but we are not a startup. The company is a mature company with 8 years experience, with more than 1 million transactions made, with a very well-organized and performing team. So we potentially have all the pros in terms of growth that venture companies can give without the cons, because we are not a young team. We are senior and experienced team. So the 3 things together, from my point of view, as a synthesis, We have a fantastic market, very high level package of services in the company, and a very senior and solid team. So the three together, to my point of view, make me think that our stock is at least interesting to be watched.
Wonderful. Thanks so much, Siro, for outlining that for us. And thanks for taking the time to come on.
Thank you, Francesca. Hope to talk to you soon.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Vadim Alexandre, Head of Healthcare at SP Angel. You all right, fella?
How you doing, Justin?
Yeah, well, I was going to say, our last week's podcast sparked a bit of debate because we did mention Novacyt, of course, a very well-followed stock just due to the performance it's had. Phenomenal performance last year, best performing stock of the year. I did sort of carry it on the weekend podcast. I just mentioned that, if you think that I got a bit of flack from our podcast, and so I said, listen, all I'm saying is this. I say it's the best performing stock. You never see stock do that 2 years in a row. In fact, you never see the best performing stock make it in the top 5 for 2 years in a row because they've risen so much, so fast. And you can't do, I don't know what it did, 60 times, I think it's original value in last year, which is phenomenal. Now, if you do 60 times their market cap now, $500 million, it's hard to do. You can't justify that value. So I got a bit of flack there, but I'm sure some people understood where I was coming from. I'm not saying that it won't grow. I'm just saying it won't grow at that rate that it did previously, because that was phenomenal, and that was out of the ballpark figures, phenomenal last year. So that's what I was saying. Yeah,
there's always this mathematical problem of small base effect, right?
Yeah, exactly.
So, if you're growing from 10 million market cap to 20 million, you've doubled, right? But now if you double again, you've got to go to 40 million.
Yeah.
So that's exponentially high.
Exactly. I always said, it's a lot easier for a company to go from, 10 million to 20 million than it is from 100 million to 200 million, also from $500 million to, $1 billion, because you have to generate, so if you're going from $500 million to a billion, you have to generate $500 million of value. That's very hard, or potential or perceived value. Whereas to generate 10 million of perceived value, it's not as hard for a listed company. So that's why a lot of people go into small cap stocks, micro cap stocks, because the chance of them doubling are a lot higher than bigger cap stocks. Anyway, let's talk about. Let's move away from Novacyt. So, what's your thoughts? Any news out this week, Vadim?
Yeah, there was. So a company you and I have been kind of touching on in the last, for the last few months. Is tissue Regenix, and they put out a trading statement this week, so it's probably worth just talking about that trading statement. Yeah, go for it then. And I did look on their timeline just now, and they've moved to electronic reporting, which is nice. I thought that can't be the news. Trading update, right? That's it. It's going to be very odd if you come on and said, "Well, they're moving to electronic reporting." That's very exciting. No, it was the one before the announcement before that. Yeah. So exactly. That's funny. The announcement on the 8th of February. So they put out a trading update for the year ending December 2020. And this is kind of what I was waiting for. We mentioned it, I think, a week ago, or maybe the week before that. And then we've been mentioning it over the last few months. I think you asked me point blank, this must have been 2 or 3 weeks ago, what was the last stock you bought? Tissue Regenix was the last stock I bought. I bought it over the summer. It's one of these stocks that is what I would call the echo post-COVID. So they're involved in, they are basically an input to orthopedic. They have orthopedic products. They have some of their products go into the orthopedic sector. Some go into the dental sector. They also make heart valves. Basically what they are all routine surgeries that have all been postponed due to COVID. Yeah. My thesis is that there's going to be an echo in all these routine surgeries after COVID subsides. And it's just because it's inevitable. Knees need to get replaced. People have to go back to the dentist. Surgeries need to continue happening. It's just a question of time. So what we're seeing currently is a lot of those stocks were hit badly during COVID, and they're recovering slightly now. Yeah. But then. In fact,
did you see that news? Did you see the news out? Sorry to butt in. There was news out just now, a couple of minutes ago, I think about half an hour ago. But the number of people waiting more than 12 months to start hospital treatment in England was 224,000 in December. That's the highest monthly number since 2008. So you can see how many people need to go into hospital,
Yeah, exactly. And this is all, I would call it inelastic demand. It's elastic today because COVID is impossible. The situation is, very difficult. People don't want to go to hospital, but it's inevitable because these surgeries need to get done. All these things need to continue. So all you get is pent up demand. And so I can foresee, and the timing is the trick as always, but it's almost an inevitability that these surgeries that were postponed get done. And then you have your regular surgeries that get done where, the return to normal will cause this echo where you'll have probably a year or two with maybe, substantially higher surgeries just to make the catch up, right? Just to catch up. So that's the echo that I'm expecting, whether it's in second half of 21. And that's what I think is, it'll happen sometime in the second half of 21, provided COVID does subside and, the vaccines take effect. It can't be delayed forever, right? It certainly, even with COVID in place, some of these surgeries have to pick up again because people just cannot wait forever, right? So we're already 1 year into this crisis. Maybe a second year somewhere in there, you'll see these surgeries start to pick up. And certainly by the third year, we'll probably see some form of normalization. And that's where the echo will be in full play. So you'll have the, say call it in 2022, you'll have all the regular routine surgeries coming on stream, plus the echo of the 2 years that have been below average because of COVID. Specifically, 2020, which was a terrible year for routine surgeries, right? Yeah. So Tissue Regenix is one of these stocks, and that's the reason I bought it. And it's done okay, and I just think it can continue going for quite some time. So what's the trading statement about? So the trading statement, this company is, relatively new to revenues, but they're doing pretty well in terms of revenues. So they have about just shy of 13 million sterling in revenues in 2020, and they've had a year which was like for like on 2019. But why is that important? Is that even in the face of what was effectively almost a stopping in routine surgeries, okay, in 2020, they still managed to keep revenues level. And that's because underneath it all, there's strong growth in revenues. So the years prior to that, I might be wrong, but it's something like 1, 3, 5, 12. Okay, so the revenue progression of this business is that they've only started to launch their products 3 or 4 years ago, or maybe 2 or 3 years ago, and the revenues have come up pretty strongly. Now, one other element to this is they're building an expansion to their facility in the U.S. They have a facility in San Antonio where they make most of their products. They needed to expand that facility to meet demand because they were hitting capacity constraints prior to COVID. So that was testament to the demand for their products in a normal situation. And the second testament to that is even under COVID, they managed to keep revenues level. So I really do think COVID is masking a growth trajectory here. And if you look at the stock price over the last 6 months, it's just gone up and up and up in a systematic way. And over the last couple of weeks, it's spiked a little. The trading statement, I think people didn't fully understand it because of this like for like same revenues, but it's 100% COVID related. And the key is the next 6 to 12 months to see that trajectory return as COVID subsides.
Mm-hmm. What's the market cap at? About 48?
It's about 50 million sterling, yeah.
Yeah, 48. Okay.
And again, look at that compared to other companies out there in healthcare. Like the Omega Diagnostics, I think they had a trading statement today where revenues were like 7 million, I think 7-8 million, and I think the market cap's it's nearing 200 million. Am I wrong?
100.
So that's on 20 times revenues or more, whereas this is on roughly 3 or 4 times the revenue, and like I say, the big question here is how fast will revenues expand post COVID? It wouldn't surprise me if this company, was doing 20 to 30 in a not too distant future. So whether that's in 2021, 22, or 23, I don't know. Probably 21 is a bit too ambitious because we're still suffering from the COVID crisis. But, it wouldn't, as you always say, Justin, financial markets are, leading indicators of what's going to happen, right? So they price in what's going to happen in the future. So you can imagine, the stock's moving, right? It keeps moving. Volume is huge volume in this stock as well for a stock of its size. And it's been consistently moving month in, month out in the right direction. What I suspect is going to happen is you're going to see the first inklings of that revenue growth trajectory returning. So probably sometime in Q2, Q3, where you see COVID subside, demand starting to increase again, and the uptick in sales. That's when I expect further move in the shares, because then you can tell whether they're going to go from 13 million in revenues to 20, 30. You know what I mean? 20.
Yeah.
So I think in 2021, look, this is me just guessing, but I wouldn't expect flat sales. Always bearing in mind, provided that COVID subsides sometime in the next 2 quarters, I would expect 2021 to be definitely stronger than 2020. And the question is by how much? Will they do 15 million in revenues, or will they do 20 million in revenues? Somewhere in that range, I expect. And the closer they are to 20, the more likelihood they'll do 25 the next year, right? And then think of the valuation: 50 million market cap, on 2025 in revenues forward year. Let's say like going into 2022. Compared to the Omegas of this world, it's night and day.
Yeah. So they didn't say here. I'm looking at Omega here. They say in summary, group revenues expected to be approximately 9.3 million, with an EBITDA loss in the region of 2.1 to 2.3. Despite considerable scale up, year-end cash expected to be in the region of 5.5 to 6. So, so if you compare 9 with Tissue Regenix at 12.8, they've got cash of 9.5, so more cash, more revenue. What we don't know is the EBITDA. So, do you know what they're going to be doing loss-wise, or?
No idea. No, I don't think they gave any indication of what forward. So the history is worth noting here. This company is the product of a lot of investment by the Woodford Fund. This is over the last 10 years.
Yeah.
If you look at their stock chart, it's disastrous historically. Like in the time to get in is post investment.
Yeah.
When it's re-rated downwards, and that's the situation currently, right? So basically, when Woodford's fund collapsed, there was a massive overhang in the stock. The stock price tanked. Company was in slight financial difficulty. They didn't have a key shareholder to rely on anymore. And the stock price just really went to a very, very, I think it was like 1 PE, okay? And then they needed to refinance. So they did a significantly discounted placing, I think about a year, in June 2020. And it was a 75% discounted placing. They did it at 0.25p. And then from then onwards, the stock's never seen that level again. Now it's at 0.7p. And you look, these all seem like small numbers, as in terms of it's a penny stock, but it's a revenue generating business. It's there's a business there. It's a proper business. And this is 10 years of development capital put in. And right when the revenues start taking off, you're getting it at a really low price. That's exactly the types of stocks I want to buy.
Yeah. Well, I'm looking at last year. So their loss last year was 2.1 EBITDA loss. So I can't see it being more than that, because the revenues are higher anyway. So, and I'm assuming
there might be
cutting.
Yeah, exactly. That's the other thing. So new management. So like I said, there was some turbulence, and there's significant turbulence in the business, but it's finally been put on the right track. The last management team helped in the reorganization. They did a great job. The new management team are US based, and that's where the sales are going to be coming from, right? So that all makes sense. And so far, so good. They've put in good measures, good cost controls. They're fulfilling the plan. That like for like revenues was kind of expected by the market. So there's no surprise there. Here we go.
They say there's
EBITDA 4 million loss. EBITDA loss of 4 million last year.
Yeah. And so they say here that they've cut an annualized cost base by 700,000 here on.
Yeah. And last year's EBITDA loss expectation was 4 million. So look, I don't know if they said that, but that was the market expectation. Okay. So they might have beat that in terms of burn.
But look, do you know what, the chart is looking good though.
They have cash, right? So
they got cash. Exactly, they're not going to lose that much for it. Exactly. And looking at the chart, it's come around nicely. It's literally bottomed out, like you say, for a long time. It's bottomed out around that 0.376 level. And now it's starting to rise, and it's almost double that. But it hasn't been a fast riser, which is quite good. It hasn't been an aggressive jump up.
Riser.
Slowly bending upwards. All the moving averages now. In fact, you know what we got there, which is quite good? Oh, we've had the golden cross, which is the 50-day moving average, crossing above the 200-day moving average. Now we're going to get the 125 close to crossing, and the 200-day moving average is coming around, starting. It was going down, coming around. That's the one. Once that starts to flatten out, that's very good. It's pretty much, you can see it, base there level to build off.
And the
Marvelous.
other thing on that, Justin, is it's an extremely liquid stock for this size, which means that, somewhere in this picture, the price is the right price. You know what I mean? So this isn't like distorted. It's not a distorted price. There's a lot of people buying the stock, is my point.
Yeah. Marvellous stuff. Vadim, thanks for that, fella, and we'll speak to you next week.
Excellent. Thanks, Justin.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is John Meyer, mining analyst and partner at SP Angel. Right, John?
Yes, I'm good, thank you.
I see that I'm just looking at, let me mute this, I'm just clicking on a Bloomberg link here, which is talking about JP Morgan says commodities may have just begun a new super cycle. What's a super cycle? I like that. When I was a kid, I used to think the bike I had for Christmas was a super cycle. Well, what is a super cycle? What's going on there, John? Explain that to us.
I did see the JP Morgan team justifying what they were doing and giving a bit of a definition for a super cycle. Although I wasn't aware that there was any particular definition for a super cycle, but a super cycle in my mind is when the market really takes off from a commodity perspective or from an economic perspective, and so where you see extraordinary levels of growth, usually lasting several years. We saw a super cycle in the early 2000s, or shall we say, really culminating in the peak of that super cycle in 2006, 2007, just before the world came crashing down with the subprime crisis. Thank you very much to the American banks for that. And of course, that was a debt crisis where the banks were refusing to lend to each other. Not that anyone needs reminding about it. And I think we're heading, the stimulus programs that governments used created a second super cycle. So the first super cycle was the Chinese government creating huge growth through construction in China, and all that culminated in peak prices in 2006, 2007. Then it came crashing down with the subprime crisis. Then we had another mini super cycle, I would call it, led by stimulus packages in China, in the US, because there was a lot of deleveraging of companies and debt availability. If you remember, companies like Glencore suddenly had problems with their revolving credit facilities and had to restructure their debt books, and that had the potential to become a bigger crisis. So what we saw was this stimulus and, shall we say, new growth that drove commodities back up to high levels. Now what we're seeing is because of the COVID crisis, which is a much bigger threat to the global economy and to many, many sectors, we now see a lot of stimulus money being pledged, the US pledging $1.9 trillion, and that's gone through the Senate, and that can almost certainly go through Congress as well. Plus, China has been pumping funds into new infrastructure. I mean, it was doing it anyway, but it just accelerated what it was doing, which is why China has been so quick at reviving economic growth and pushing ahead. And whilst China might touch the brakes from a debt perspective, it's definitely not going to slow down on developing its economy and developing the infrastructure. It recognizes it's in this sort of Goldilocks period where it's able to push through the development of road and rail and new suburban housing projects and all sorts of stuff like that without any real environmental opposition. I mean, you're in trouble if you oppose the Chinese government, and you end up in a correctional facility really very quickly, I think. So they are pushing that at a pace, and they're determined to overtake the United States in terms of economic superiority and probably military superiority at some point. So if you've got the China growing, the US growing, and of course Europe catching up somewhat behind everybody else, as is normally the way, then you are going to get this super cycle from a metals perspective. And add into the mix the fact that everything is now being electrified, electric vehicles, renewable energy, offshore wind farms, all this sort of stuff is just a huge movement. Add it to the mix, and we can't see where the metals are going to come from.
Yeah, it's very interesting. I'm just looking at that chart there, on that Bloomberg article. And it's, like I said, last time it happened, it went from almost 1970, and it peaked at sort of 1980-ish. And the trouble is, though, after the super cycle, we tend to have a collapse. And then the next one, literally, it collapsed in the 80s was bad. The stock market didn't go anywhere for a while, up and down. And then it went up again, like you said, the early 2000s, up to 2009. And that's where we had a big collapse again. So it lasts for a long time, it looks like. And they're saying that, they're saying the vaccine, stimulus around the world, optimism, and like you say, electrification. Do you know what I was thinking yesterday? And I don't know what this means for the economy, but if you look at all the people, and it's just, I'm looking at it from an economic perspective, of course, there's real lives behind this, but if you look at the people, the majority of people who died via COVID-19, they are above the age of 80, generally non-earning people who are taking pensions and all that stuff. So you got that strata. So what I'm saying is, will this, I know it's a horrible thing to think, but if you wipe out that strata of people whose immune systems are weak and they're not working, they're not producing anything, then surely the population as a whole becomes more efficient productively, don't you think?
Well, you have a point, but we don't need to worry about that now because the vaccines, and thank God the government's getting the vaccine program out.
Yeah. I suppose there's not a lot of people, but I suppose there's millions of people have been killed though from that thing, So I just think, what? Sometimes when you go through these periods of the markets are rallying on this, of course, but we go through these periods. And generally, the businesses that survive, and we can put this from a business perspective as well, the businesses that survive and thrive are the strong ones, and they get stronger, They take more market share, and so they grow faster again. So you do have these cycles that happen. So I can very well see it happening for the next, we need a big, so obviously it'll be a bit bumpy, and we'll have a couple of corrections maybe, because the economy has to catch up. But I do think we'll have a bullish next.
You hit on a very good point there. The companies that survive will be in a fantastic position to take advantage of the growth that we are about to see. And yes, it's absolutely worth supporting those businesses. And personally, I'm pumping every spare penny that I've got into the stock market because it's all happening. I was very concerned a few weeks ago when we heard reports of China locking down cities because they'd had renewed outbreaks of the coronavirus, but we've seen very few reports since then. So I think the risk is less. I think the great thing from the GameStop saga in the US is the hedge funds have had their wrists slapped and they're not shorting things in the way that they were before. So thank you, Mr. Musk, for doing that. And I think the markets are off to the races because you don't want to be investing in bonds in a hurry because the interest rates are so low, and all the growth is going to come out of the equity market, which is the place to be.
Yeah, absolutely cool. Okay, so what stocks have you been buying, John? Now you've really gone into it. What stocks are you going to look at?
I'm buying. I bought a couple of oil stocks.
Oil? That's a contrarian play, but that's going to expand, of course, I mean, oil's going to come back, I think, isn't it? Definitely.
Yes, yeah. Well, oil is already coming back. I mean, it bounced quite quickly last week and this week, so it's pretty busy there. I bought a pharmaceutical stock, but it's not my area, so we leave that to Vadim to talk about.
Which one? Tell me.
I bought Evgen Pharma. Okay. I thought that was quite interesting.
What do they do?
They just do something pharmaceutical. It was something that
I love that.
Vadim was talking about a while ago.
yeah, they do something pharmaceutical. That's what I need to know. Yeah, that's fine. Cool. Okay, cool. What else then? What else?
Arc Minerals. I bought some more of that because look, they're doing they're likely to get an offer from Anglo American. We know Anglo American. When I say an offer, it'll be an offer for a joint venture or some form of participation in their underlying copper projects in Zambia. We know that Anglo American have done their technical due diligence. We believe that passed from a technical perspective, and Anglo American are just looking at what I believe what sort of offer they're going to make and doing their corporate due diligence. So hopefully that that will all go through. It really now is up to, well, will that offer be good enough for the CEO of ARC Minerals to accept? Now, remember that Nick von Schoending, who's been in the mining industry for a long, long time, he used to work at Anglo American. We used to work very closely with the chief executive. And I think he understands what this sort of offer can be worth. Hopefully, Anglo American will put some money into the company, and I'm sure that Anglo American will end up investing in the underlying assets. So I say I'm sure. It really depends on the quality of the offer they make. So for me, I think the risk is worth taking. I love the exploration portfolio that they have in Zambia. I think it's absolutely the place where you're going to find more copper. We know, in fact, the couple of the projects have got quite a lot of near-surface copper of very good grade, and I think they're going to go into production in a small scale, probably about 10,000 tons a year, starting probably 18 months' time. So they're working on a scoping study for that at the moment. And I say small scale, but 10,000 tons a year is over $80,000 of saleable copper. So they'll produce a concentrate of some sort. They won't get $80 million a year, but they'll get something close to that. I think it'll be very worthwhile. It'll be funding that they can use to explore the rest of the portfolio and hopefully find something much bigger.
Cool. What else then? What else, John? Anything else?
We've been writing about Bushveld Minerals this week. They came out with a fourth quarter statement and full year production and sales numbers. They confused us all with these intercompany sales figures. So it took a little bit of working through. Yes, they're reporting a loss for 2020, but then who isn't? And I think Bushveld is a good example of a company that is a survivor. It is growing. It's got the funding to grow, which is great. Not just at the Vametco vanadium project, but also at the Vanchem vanadium facilities as well. So they are a growing producer, and they also have this technology business where they're going to produce vanadium for these vanadium redox batteries. And the really clever thing is you're going to be able to lease the vanadium for the batteries, and these batteries are for utilities. They're large-scale, utility-scale batteries to support offshore wind farms and solar farms and stuff like that. And I really think this is going to be a driving force for Bushveld going forwards. And I'm a big fan of the company. I'm sorry to see that they've pulled back on their production estimates for next year. I wonder if they're just being a bit overcautious with that, which I think is a feature of trying to underpromise and overdeliver. They haven't been terribly good at that in the past, but I think they're going to get better at it. And I think they recognise that the COVID restrictions have the potential to slow everything down a little bit.
Yeah, absolutely. Marvellous. Any other news on anything else, Johnny?
Well, there was Altus Minerals, a new discovery up in Mali at their Diba project. So some pretty good grades coming out of this. The new discovery is just 1.5 kilometers away from the Diba discovery. So that's nice. I think that's adding value. And I think we're going to hear a lot more from Altus on what they're doing with this gold project. Grades of 8.5 grams a ton, 6.5 grams a ton. Really quite nice. So I think what's going to happen is there'll be a central mine there and a number of satellite deposits, and hopefully they can process this through the process plant of one of the nearby gold mines, because they're in a good area for gold mining. Government's incredibly supportive, and I think Altus is going to do well off the back of this.
Yeah. Excellent stuff. All right, and any other news at all, Johnny?
Well, Solgold, bit of a reality check for those guys. They've delayed the pre-feasibility study that they've been working on. So they're looking to develop a huge copper mine in Ecuador. And when you're planning something of that scale, and it's a block caving operation, which is technically very complicated and difficult, and the CEO moved aside in order to allow, shall we say, more expert people to take over and run this, and so they're looking at all sorts of different ways of optimizing the mining process, maybe not doing the 6-kilometer declines that they were proposing, perhaps to put in shafts, that sort of thing. There's a lot of work that, in the planning stage that needs to be done, and it's worth taking the time, because this is going to be a $3, $4, $5 billion project one of these days, and it needs a lot of thought. So these things always take longer than anyone expects, and they were rushing through the feasibility study on a project of that scale is a very false economy.
Yeah, cool. Marvellous stuff. Johnny, anything else worth talking about?
I think that's probably it for the week. The mining sector is, the boys are busy trying to get things done. There's a little bit of news out of Kodal Minerals of some geochemical sampling on their gold projects. So you've got the Chinese in there looking to develop the lithium project at Buguni. So we don't know whether they'll say yes or no to that. We know that the Sue Chin investors or shareholders in Kodal are very keen for that project to work. They invited Power China in, or one of their subsidiaries, to look at developing the project. So hopefully they'll say yay to that. But in the meantime, Bernard at Kodal is getting on with developing the gold portfolio. And why not? Mali is a brilliant place for finding and developing gold mines.
Yeah. Marvellous stuff. John, I was just looking at Solgold's share price. Yeah, it's not it was like 40 pence, wasn't it, a few months back? And now it's 20. It's halved. So, it's a tricky, sticky time for them. But there we are.
The thing I really like about Solgold is the other exploration in Ecuador. They were very quick to go and grab a lot of the better looking exploration territory. What Solgold are really good at is finding things. I think eventually they'll find something better than the Arpala project in another part of Ecuador, something that's closer to surface, and which will have bigger and better value and probably a lot easier to develop.
Yeah, absolutely. Marvellous stuff. Cool. John, thanks for that, fella, and we'll speak to you next weeky.
Look forward. Thank you.
Okay, it's time for the top 5 most followed companies on Vox Markets in the last 24 hours. They are at 5, Microsaic Systems, up 14 or 15% to 0.275. Gene Drive at 4, down 2.76% to 141. At 3, Omega Diagnostics, up 3.23% to 96 pence. At 2, GS Technologies, up 23% to 3.9. And at 1, MGC Pharmaceuticals, up 50% to 4.1. Of course, don't forget, there is a podcast webinar with them. I'm hosting that tomorrow. Investor presentation and questions and answers afterwards. Please go to voxmarkets.co.uk to register for that. Okay, top 5 most read RNSs are as follows. At 5, it is Ascent Resources Strategy Update, new funding. At 4, Brand Shield Systems Trading Update. At 3, N4 Pharma Notification of Intention to Grant Patent. At 2, Landor Resources Drilling Update. And at 1, Omega Diagnostics UK Government Contract and Trading Update. That's it for the podcast. Thanks for listening. Muchos appreciato.
The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.